Okay, good afternoon, everyone. We still have people logging on, but we're going to go ahead and get started. Welcome to Kiser Group's first virtual mid-market summit. This is something we've been able to have every year live, but due to the pandemic, we are attempting this virtually. So we're thrilled to be doing this series on multifamily. We're going to have 3 panels. One today, one next Wednesday, and one the following Wednesday. Today's panel is on finance. Next week's will be on technology, and then the following week on construction. So we hope you will join us for all of these. You can also learn more about each of these panels by going to kisergroup.com and then click on the mid-market summit icon on our homepage. Today's finance panel discussion is going to be moderated by Kiser Group's own Rick Ofman. And the topic, again, multifamily finance. Rick, I'm turning it over to you.
Thank you so much, Lee. So very excited to be moderating this finance panel and even more excited about the panelists that we have on here. We have a very diverse group of operators here that do business from geographically very different areas on a different scale and have very different business models. So I'm hopeful that, everybody listening, from the, investor that's looking to acquire their first building to the portfolio owners with, over 500 units, 1,000 units, will all learn something valuable. Goal is one tidbit of information that you can apply to your own business that'll make this a success, at least for me. So you'll notice that the chat function on Zoom is on. If you do have a question or comment, please feel free to make it. I can't guarantee that we'll get to any comments at all, but I'm hopeful that there will be some good ones in there. And please keep them to finance and to the panelists. We don't need to make comments about sales driving. Anyway, we're going to start with introductions. I figured the panelists will do a better job of introducing themselves than me. So what I'm going to ask panelists is who you are, what you do, where your business is, and just to keep it on finance, what on your last, most recent acquisition, what did the financing look like, and who originated the loan? So let's start with Michele. Why don't you get things kicked off?
Hi, good afternoon. Happy Cinco de Mayo, everybody. I am 1/5 of Boyd A. Jarrell and Company, family-owned business since 1950-ish, and we're located in the south suburbs. We own and manage about 650 units, south side of Chicago, west side of Chicago, and the south suburbs of Chicago. Our most recent acquisition was a 77-unit SRO in Hyde Park. It was financed, we acquired it on 11/4/2020, and CIC, Community Investment Corporation, did a first loan and a mezz piece to the acquisition.
Okay. Thank you. Allison, same questions to you.
Hi, everyone. My name is Allison Richman. I am half of A2 Real Estate Group. We are, we acquire, renovate, and self-manage multifamily in Chicago's West Side. So we have just over 100 units in East and West Garfield Park. The last building we purchased was 2 months ago. It's in East Garfield Park. The loan was originated by Amalgamated Bank of Chicago, and it's a value add deal and loan, so a little bit of capital improvement structured in there.
All right, thank you, Allison. Next, we're going to go with Matt Beary.
I'm Matt Beary. I'm principal and partner in Clarity Strategic. We've purchased primarily in western suburbs and southwest suburbs of Chicago. We've owned about 1,500 units in Chicago. We currently own 300 units of primarily what I call mid-sized multifamily. We usually focus on value add properties And our most recent acquisition was 80-unit building through Kiser, which I think is why I got invited. That was not really a value add, it's more of a cash flow deal for us. So we had a lower loan to value of 65%. We acquired that with Freddie Mac financing using a 65% loan to value. And it's a good acquisition.
All right. Thank you. I noticed none of the panelists are mentioning the interest rate that they got on it. So interest rate must not be important. That's good to know. Sal, take it.
Actually, if you can, I'd like to hear Dean, and then bring Dean. I
want to. We'll go with Dean. Thanks, Sal. Dean?
Thanks, Sal. Hey, Rick, Lee, Sabrina, appreciate the opportunity, and for everyone tuning in today. Hopefully, we can be of some value. I'm a mortgage banker with Walker & Dunlop. Most of my business is in Illinois and in Wisconsin in the multifamily space, hopefully applicable here. I do a fair amount of other types as well, so mixed use, industrial, self-storage. In the multifamily space, W&D is a top lender with the agencies. And personally, I have an active mix of conventional Fannie Freddie clients, as well as some SBL clients, small balance clients as well, with the cutoff being roughly $7 million or so. For those deals that don't need or don't want an agency execution, I've got a stable of about 50 or so life companies that my office transacts with annually. So a good spectrum of options for us. Do also do a fair amount of CMBS and bridge and bank business as well. In terms of loan size, I'd say really anything $2 million and up works sufficiently. A recent deal we did was Graceway Corners, which was a Kiser listing. But Rick, you had mentioned possibly exchanging some more stories. So if we've got time, maybe we save that for the end.
Yeah, we'll do that one at the end. I've heard just snippets from that one. So, well, without further ado, Sal.
Well, first, we're going to call you the MF professor. I know you're the. We're going to say MF multifamily.
I think we're going to stick with
something else. Not something else. Because of your high school background, so I'm going to try not to. You're not going to. Hopefully, not going to bring out the 17-year-old in me, and I'll throw virtual spitballs your way. I know that was your other life as a high school teacher. But first, I'm so happy that you invited me to the finance panel and not to the construction panel, because I'd be complaining about lumber and supplies and fridges and all that other stuff that I can't get or I'm paying an arm and leg for. And I like that you started off with the finance panel to kick things off, because as an owner operator, we've been doing this for over 40 years, family business. We're focused in 3 core neighborhoods: Edgewater, Rogers Park, and Uptown on the north side here in Chicago. By the way, I'm on Ashland and Division at a stop sign. There's a line behind. I'm pulled over on the side. It's one thing, and I'm back to why you started off with the finance panel is so important, because sometimes we can get caught up in getting the deal, and we don't really, and we get caught up in, okay, did I get a good deal? Did I get a good credit? Did I, am I going to find the right vendor for a property and all that other stuff?
So most recent acquisition. Let's just stick with that. We'll dive into all of this.
Okay. I just want to say that how important it is that we got the finance, how important financing is in this this mix, and we overlook it. We know it's important, but we overlook how important it is and how important it is to get the details on the nuance of the different financing out there. So okay, so you want to know a deal that one deal.
Most recent acquisition. What kind of debt did you put on it?
For example, deal that we're about to close in the next week. It's a very simple deal. It was a deal that Chase Bank recently. They finally, JP Morgan Chase is looking to come back to the market, hopefully. And it's a very simple deal, 70%. And the rate's at a 5-year deal, fixed that we're going to be at a 335 or 315 with an affordability discount, which they're offering these days. I know Dean at Walker Dunlop is doing the
So-
same. So yes, that's a deal.
Great. Thank you, Sal. We'll get into the importance of finance. I think that's why everybody's
okay. Sorry. Okay.
come in here and realizing that the financing does really make the deal on any acquisition. But I'm curious, you mentioned Chase is your lender. I vaguely recall Chase disappearing for about a year there once the pandemic hit. And that kind of opened the door for a lot of these neighborhood banks and smaller banks to fill that void, especially with refinances. And I'm wondering, how have things changed, right? The pandemic changed in that way, but I guess what are the new requirements that banks are asking? Maybe Dean, you can talk more on that. How are banks underwriting deals, and how is it different than pre-pandemic?
Well, maybe I'll speak to COVID reserves, generally speaking, and we can kind of take it from there. The life companies generally are not requiring COVID reserves. The banks generally are not requiring COVID reserves. Fannie and Freddie are, though, and they're generally flexing with leverage and debt coverage. So your highest leverage deals are usually requiring 9 to 12 months of P&I. The low leverage deals, of course, get none, and most of the market is somewhere in between. So if you've got a strong sponsor, you've got a bunch of IO structured in the deal. Generally speaking, you can adjust those reserves from P&I to interest only. So that's a win. If the agencies see that you've got a strong deal or a strong sponsor and you're in that middle leverage point, even max leverage deals are getting waived on the COVID reserves, generally speaking. So things are really improving there. If there is a COVID reserve, it's generally held for about a year and then released with performance. So that's kind of COVID reserves. Really the challenges since the pandemic have been anything at max leverage and anything with a lot of retail and non-essential businesses have been kind of the greatest challenges.
Yeah, I mean, Matt, I think you mentioned that you were at 70% loan to value on your last deal.
On the last acquisition was at 65.
65.
But we did a full-term IO. And we do have a 12 months of P&I reserves. On a refi we're doing right now, we have a relationship with a local bank that basically matched Freddie's terms with no P&I reserves. And more importantly, it's a mixed use deal, and they were fully underwrote the office on the first floor, where Freddie was essentially discounting 100% of that income.
Okay. So I'm hearing loan to value is a big deal. And I know, Michele, when we talked about, before we hopped on this call, you had mentioned that loan to value is one of the biggest, most important terms of any deal. How are you seeing changes in the market right now with that?
I haven't seen any changes. It's been, I would kind of say, to piggyback off of Dean, you can get a deal financed, it's very difficult to find money where it's 100% financing if you're going to be in the commercial space. The residential space may still exist, but in the commercial space, just right now, it doesn't. The deal that we did with CIC, closed with CIC in November, we just got an acquisition and we were going to fund rehab through cash flow from operations. So right now we're kind of like wait and see, how does it look? I know from a personal perspective, I have a single family home that I was trying to refinance, and that has been difficult. Investor single families, I have found I was kicked out of US Bank and I was kicked out of Citibank. They didn't want it at all. So now I've been told by a friend of mine that Belmont Bank is, will do that kind of refi. It's a small loan. It's $85,000. So just some of the smaller investment stuff is probably a lot more difficult than the multifamily res.
I don't have much experience with the single family home loans. So can't speak to that. But Allison, are you seeing anything different from banks in terms of requirements and underwriting? And I guess the other thing that somebody mentioned, and I can't remember, I think it was Dean who said the strength of the sponsor was something that you found important. Can you speak to that at all?
Yeah, I was gonna say, I think, so early in the pandemic, May, June of 2020, we sold 4 buildings or so. And so that was a little bit questionable on if the buyers were able to get their financing. And ultimately what it came down to though was each of the buyers we had very strong relationships with their banks. Appraisals at that time for our buildings did not get affected. And just for perspective, that was an 8-unit, a 9-unit, and then 2 4-units. So, you know, the buyers thankfully had all good relationships. And then the building we just acquired, Rick's familiar with that one. It actually, again, it ultimately ended up being a new relationship for me at Amalgamated Bank, but it was a referral from a different lender. So I think a lot of it just came down to, I mean, trust and relationship, right? But in terms of the terms, you know, 75% loan to cost, 75% loan to value. I think the rate was 4%. So not, I mean, I didn't see a ton of change in our product type with me as the sponsor year over year. But I do think it's just a little bit, at least again, in what I'm doing, it's a bit more work, right? There's more explaining to do in terms of how's the eviction moratorium going to affect your, you know, this building, and just explaining what policies and practices as an operator you have in place to overcome that.
Yeah, the eviction moratorium we can get into in a little bit. We did just have a question that I was thinking of, and this whole time, and it came from one of the viewers about recourse versus non-recourse, and how does that affect your decision on, you know, assessing a purchase. Sal, haven't heard from you in a while.
Right now, currently, recourse. Well, currently we're a family office in the process of. We've been very lucky and happy to take the next step and go into syndication. So when you own everything and you own 100% of something, the recourse question is probably not as important as if you go into syndication. And we've been very happy we found a great equity partner at JV and an LP partner who's really, we have a big deal in Milwaukee that we're getting into and hopefully closing in the next 45 days. And that one, we're talking to our bank there, and we're saying, okay, work out make sure there's some recourse. The recourse would be less, right? So there's certain things that you look at, but for sure, we've been doing deals with Dean's team, Luke Erlinson and Walker Dunlop. We've done refis, big refis. They've taken out some projects we had about a couple of years ago, and we finally got them to stable last year. And they really, non-recourse is great. I mean, it looks good on your balance sheet, but is it something that, though we own it 100%, you know, it's good to have, you know, what I'm told is if it's not on your balance sheet, it makes your balance sheet look a little bit better.
So I guess what would you give up to get non-recourse? That's
the question, and then that we can ask Dean that question of what is the additional, how much basis points are you willing to pay to have a recourse compared to a non-recourse? And I haven't come up with that calculation, to be frank. I don't have that calculation in my head. Maybe Dean might have something. He wants to chime in on that, because he does a lot of that.
Some lenders are just non-recourse, and some lenders can kind of do both. I'd say that if you were doing a bridge deal, for instance, say a 3-year bridge deal, maybe it's AC rehab or something similar, and you were looking at, say, 70% leverage. If you pursued both recourse and non-recourse options, you're at least 50 basis points wider and perhaps 100 basis points wider for the same deal.
50 to 100. Wow.
Now, if you're talking agency is always non-recourse with carve-outs in max leverage, and then it slides down to no carve-outs towards towards the 55% lower leverage deal. So, you know, what you're talking about is, you know, typically the shorter term deals. Now, most banks will offer up non-recourse sub 65% LTV. depending upon the deal and how many moving parts and how stabilized it is. But, you know, I don't disagree with your comments, Sal, that in a syndicated disproportionate model where you own 5% of the deal, it doesn't make a lot of sense. I would highly recommend, unless you're building and you need to do it.
Matt, when was the last time you did a recourse deal? So you're a syndicator.
I would never do a recourse deal. It's just not necessary. With the agencies there, with Chase Bank on a non-recourse basis, you know, the local bank, we were really, really pleased on a refi that we're doing with the local bank where they agreed to come in and do non-recourse. I won't say, we took a little bit of recourse, but they had a limit to it. So if it was a $5 million loan, we had a $500,000 full recourse, and then after that it was non-recourse. So
Matt, what was the additional spread of basis points that a Chase would?
Well, I guess that's my point. Is I have never seen an additional spread that I know of. I mean, if I do a deal on a current refi at 3.5%, which is where we're at, it's actually better than current Freddie rates. No P&I reserves, and that's just totally relationship driven. On that one, and you know, 3 years ago we'd never done a deal that was sort of outside the agencies or Chase, and we did one deal with this bank, and it was through an existing, somebody made an introduction and sort of brought us in as someone who you know, I guess was a good operator, and that sort of opened the door for that discussion. But yeah, we're a syndication, so we typically have 5 to 10% ownership in everything that we do, and my business partner has a lot more years of wisdom, and has had, you know, historically had some issues, and so he basically just said, look, this is a life lesson. Don't ever take recourse unless it's your own. You know, that's like Sal says, you own it 100%.
Does anybody disagree with that? Michele, I see.
No, I don't disagree. I have never run into a bank that, if I'm just doing a straight non-agency deal, it's like, yeah, like CIC is going to make you personally guarantee every single time you get money from them. So I haven't even had the experience of having just a straight acquisition or ac rehab where there wasn't, where there was a no recourse option. And perhaps I should ask, you know, who knows? Our agency deals, our Freddie deals, stuff like that. Yes, we have non-recourse, but that's just, it's a completely different monster. I've just not seen it with kind of your small, you know, your acquisition. You buy a 10 unit, 20 unit building, 70%, 75% LTV, and they're going to toss in non-recourse. So I learned something.
They didn't toss it in. It was either, you know, agree to provide it, or we were going to, you know, have to use an agency execution, which quite honestly wasn't going to get the proceeds that we wanted, and wasn't going to be the terms, you know, it was more hassle and less benefit. So it was just, we sort of got lucky, quite honestly.
Matt, what are the average size deals that you're working on?
Our typical property is 4 to 12 million. So 30 to 100 units is our target market, sort of above the guy that can do it all himself and below the institutional area.
Okay. Because I mean, my experience has been a lot of this recourse versus non-recourse is the size of the deal. So I'm just getting to the point, I guess, of being able to do non-recourse. I'm just starting the process of a refinance with Walker Dunlop, actually. And it's because it's, you know, north of 2 million, whereas anything south, the non-recourse option has just not been there.
Yeah, outside of the agencies, you know, Chase Bank, or, you know, some sort of a lending relationship that like a Walker Dunlop can bring, you know, are sort of seem to be the limited options.
So do you think it's more size, or do you think geography has anything to do with it?
Well, I mean, I did a $700,000 loan with Chase that was a non-recourse loan a number of years ago. But geography has a huge factor in Chase. They have a very refined set of zip codes that they're only going to lend on. So, you know, we've had the original deal that I did with this local bank was because Chase basically said, that's not our zip code. And I said, well, it's a great property. You know, it's a great town. Look at the average income. And he says, you know, there weren't that many other apartment buildings around, so they didn't add it to the list. And so it just didn't fit their model. And for since it was it's a deal in Plainfield, Illinois, so it's a little bit far outside. So even Freddie was saying, "Oh, it's not a tier 1," and so we were trying to push for it. It just sort of drove us to have these extended discussions that enabled us to get that loan.
Anybody else think that there's? I mean, I've heard it just in terms of geography that affects a lot on where banks are willing to lend.
Sure.
You know, what other terms are affected by geography? I know you guys do work in very different markets. Any thoughts on that?
Yeah, so I know Rick, you and I have talked about that, so it's probably prodding me a bit. So I only work on the west side of Chicago, so I don't really have much to compare it to, but I can tell you in, you know, fast forward to the war story portion of the webinar, you know, I've been retreated by lenders through 2 or 3 times, 2 times where it was really insulting. And it was due to the neighborhood that the buildings were in, which clearly did not change from the time that the term sheet was issued to the time that, you know, the final approval was given, or in that case, the final approval, modified final approval was given. And both times they cited the neighborhood as, you know, you're not gonna, I think the initial term sheet was either 70 or 75% loan to value. These were stabilized buildings. And then, you know, when it came time to it, they had dropped it to 60 or 65% loan to value and said that's the best you're going to get in this neighborhood. And, you know, in both instances, we walked from that lender and were able to, you know, start relationships and got introductions to new lenders. So, I mean, it's definitely happened to me operating on the west side.
Sal, you're shaking your head.
Well, listen, I think there's it looks like Matt, very sophisticated. I've been forced to be a little bit more sophisticated, and
I don't feel sophisticated, but
well, and getting and like for example, Michele, this idea of asking questions of, okay, can I get non-recourse, right? I dig a little deeper with the bank. One thing that I have, guys, I have 3 Bs. I have the 3 Bs of bankers that I want to be able to say before the end of the show, and the 3 H's of what to do, of how to handle those 3 B's of bankers. So I don't know if you want me to.
Sal, you've been holding this in the whole time. Just get it out of your system.
Okay. Well, okay. Here's the thing. So here's how I look at things. There's 3 kinds of bankers. There's the buffoon banker. There's the black box banker, and then there's the benevolent banker. And the buffoon banker, you just got to hide from him, because he'll come to you and say, for a 32 unit deconversion, he'll look at you and say, we'll have to do 32 different appraisals for a deconversion for a 32 unit building. Excuse me, then obviously there's no value to be added on a deconversion if I have to do 32 condo appraisals. So that's a buffoon banker. Hide from him.
Easy to identify.
Easy. Okay. Then there's the black box banker, where they don't give you any transparency on the product, and they'll pull what they pulled on Allison, 65, 60. They'll near the end, they'll pull the rug on you, or they'll make the rates. They'll hide the rates. Brokers can do this sometimes. I've had a bad experience on that. Not with Walker Dunlop, Dean, but other brokers. They'll hide that rate, and then all of a sudden they'll pull a surprise on you at the end. What's the H with that? Is you got to hammer them. Hammer. So you got to hide from the buffoon banker, hammer the broker, the black box banker, and then number 3 is the benevolent banker. They're all of them. All of them feel like they're benevolent, meaning that they're doing you a favor. And that's where if there's one thing that has come out of this past year, that they're doing you it's like they're doing you a favor for giving you the loan. Like they're making your life. They've just made your life so much more easier, and they're just like they're being out of their good mercy. They're giving you this loan. If there's one thing that you need to do with them, is you got to humor them. That's the other H. Humor them, but also remind them that after what we've gone through this past year, we are the only game in town. Okay, as challenging as our operations that we're not used to it, our operations are more challenging than they've ever been. Trust me, I'm the first one to raise my hand on that. But at the end of the day, we are still the game in town. Industrial, if you want to play that game, go ahead. All you want. The most boring game around, go ahead, do it. Play with industry. Retail, God help you. Right?
All right,
Office,
Sal.
God help you. Hotels, God help you. We're the game in town. So here's the point of this, is making sure you go to the banker and say, buddy, you can think you're giving me mercy, but you need me as much or more than I need you, because I'm on the field, buddy. I'm on Ashland and Division right now. It's bustling out here.
At a
I'm
stop
on
sign.
the field. You need me. That's what we need to say to our bankers. You need me more
Okay.
than I need
You got that off your chest. Appreciate it, Sal. So I would like to get us refocused back on finance. And I know that we were talking about relationships before and the importance of relationships. And it sounds like if you don't have a strong relationship, you might end up with one of these B bankers that Sal described. But just how important are those relationships, and what are you able to use them to leverage? Like you said, the banks are, you're at their mercy, or they're being merciful. But what advice would you give to, I guess, a new investor looking to buy some property? How do you go about developing those relationships with bankers? And I think, Michele, you might be the right person to ask on this one.
Well, thank you. I'm a former banker. I kind of started my career off. I ended my banking career as project finance relationship manager for LaSalle Bank in 2004. So in the course of my job, I met a lot of bankers. They were my colleagues. And what I find so critical is, because I knew bankers, I knew that there were different types of money out there. I was able to, I'm one person, maybe two people away from finding out different types of financing structures that, different banks offer. So for the new person who is just starting off and trying to figure out, how do I get a loan on my first 6 unit? I own some, 3 units, I own residential, I want to flip over to commercial. To find someone who is going to help walk you through the differences of those. Go to the banker you currently have. Hey, do you know anybody who does commercial? And residential bankers, mortgage brokers do know commercial bankers and commercial mortgage brokers. And the reason why the relationship is so important is because you can bounce ideas off of each other. The terms of the loan are not going to change for you. I can't say, okay, well, I have a relationship with Citibank and they're going to give me 95% LTV, or they're going to give everybody else who they don't know 70% LTV. But what it does do is it makes the approval process a little bit smoother. Oh, we already know her. We know that their credit's good. We know that they know how to do this. So a lot of the questions about like personal integrity and your moral compass, and they know your demeanor. So if things kind of go sideways, I'm going to call my banker instead of ghost my banker. And we're going to see this and use this as a partnership. So if you have a relationship with someone, there's an inherent partnership already there. So you are able to work through things. And another great thing about having relationships with bankers is they'll tell you when stuff, I've got this portfolio and this building's not doing so well. Or we're kind of not going to be lending in Chicago during the COVID, let me introduce you to somebody who is. All of that is relationship driven. So my dad says this old saying, like, don't send me nobody sent. So you want to kind of know the people that you're doing business with. And the only way you can do that is just start talking to people.
Dean, I haven't heard from you in a while. And
yeah, I don't disagree. I think it's very important for a lender to know you well. I think it's important for them to understand, why your expense ratio is so low, why your turnover is low, to Michele's point, what you stand for. I would recommend spreading out your relationships, not do all of your deals with one lender, but don't do every single deal with a different lender. I'd say that you want to do enough business to be valued, but you need to make sure that everyone always gives you a competitive bid. To your point, Michele, or maybe it was Allison. You got to fight for your terms. I've alluded a little bit to pricing and terms, et cetera, but I wouldn't always choose that lender or choose somebody for 5 basis points. Relationships are important. Repeat sponsor deals are always easier to get done, and particularly when you have asset management issues. Those issues, if you're a valued and repeat client, those issues tend to go a little better, and that kind of applies to Fannie, Freddie. It applies to life companies, and I'm guessing it applies to banks as well.
Okay, I like it. Allison, I can't tell if you're like itching to say something. I think I'm going back to my teacher days where I almost see a hand coming up and I want to call on you.
I actually did raise my hand earlier, but no, that was not recent. No. Okay.
So I heard the relationship can't really change terms. And yet all the time I hear, I'm trying to size a deal and I talk to different lenders. Okay, what do you think the rate's going to be? And they give me a rate. And then it ends up being a better rate, whoever's buying the building. And it's always, well, they do it for me, right? I got this rate. I don't know if the next person could. And I'm wondering, is there any truth to that? Does anybody feel like they get better rates because of who they are?
Let me jump in on that. I think at a certain, first, I agree. The relationship, having a big, Dean mentioned it, diversify. That we've been able to do that over the last few years. We were really just hardcore Chase up until 2-3 years ago. And then we kind of stretched out because, Matt, you mentioned it. They want down the middle and the T. Yeah, right down the middle, hit the ball, very simple, and they'll give you a good rate, right? Their costs of funds are cheaper than any other bank out there. So they can stabilize product. They can knock out in their sleep, right? Especially if it's right on their tee. But one thing that the relationship with me helped with Chase, and they have majority of our product, is when we had this rate reset that took place last year where rates dropped. We had a lot of 4.5 rates that we refied in 2018 and 2019. And they came to us and they wanted, in one end, to guard the house. So Walker Dunlop and Greystone, because that's where the agencies really started really picking up the slack that Chase on the purchase side pulled back last year, but they were just focused on guarding the house, meaning making sure that they don't lose their loans out to other refis to other places, right? Over the penalty. So because rates had dropped so bad, so low. So what they did with me, and I appreciate it across the board, and this is something I'll remember, but I also know that, it's a two-pronged thing. They want to guard the house, but they also want to make me happy. Is that they knocked down a lot of the rates that we had, like 4.5, but they knocked them down to 3.25. We would pay a 1-point fee and it would pay out after a year. So it turned out to be good. We really, what was important to us over this past year, if we're going to look at the positive of COVID, was it allowed us to refi. And this is not just me. This is a lot of operators, small, big, stock market, everybody. It allowed everybody to refi at a much lower levels. At lower interest rates, which has kind of created this still power in the markets, right? So and that relationship that I had with Chase was very helpful. I couldn't do that with Dean at Walker Dunlop, right? Fannie's going to say, you got a 4 rate, you got 5 more years there, buddy.
Dean,
if you want a supplemental, you can. Right? You can't adjust it that way.
Dean would have made it happen.
Yeah, so. Sal, Chase didn't call me and do that. So I need to give them a call. So you
have non-recourse. That's probably why. Okay, I don't know.
I mean, maybe there is some truth to it that they're, maybe the lenders are going to be giving out different things to different clients.
There's a level of discount if you have a certain amount of you're a certain client where you have a certain amount of money that you owe them.
It brings me back to what Michele and I were talking about last week when she said it's, financing. I was trying to make the case that financing is more important than any other aspect to any acquisition or this business. The financing comes first. And I said, it's a lesson I've learned after a few years. And she said, no, management is the most important. And I think they're intertwined because a lender is now, it seems like it, at least what I've read, is that lenders are looking more and asking those questions. Who's managing? What's your experience? Before we actually lend on that. Would you agree? And I do like how Michelle's answering these questions on the text chat too. Thank you very much.
No, I think that management is everything. When I was in banking, like I said, who's going to manage the property was the last bullet point of the loan committee proposal before you signed it and submitted it. And I have seen deals die, in post 2006, where if the management company isn't strong or reputable, the bank now understands if the owner of this building has to go away, if they default, the bank is left with this property. And so the bank will have to manage this property. And if it's been poorly managed up until now, the bank is really in a business it just doesn't do. So management has become just remarkably important that in my experience.
Yeah.
Let me add to that. Sorry.
Let's let Allison.
I was gonna say, I think the relationship, gets you in the door, the sponsorship strength. I do think there's a bit of a gradation, shall we say, in rates and terms, just depending on sponsorship strength. I will say just with Renovo, who I've done a few loans with, the rate that they gave me 2 years ago is different than the most recent. That's just because I now have a track record with them. So I think that speaks to sponsorship strength and execution. And so, yes, I agree, Michele, with what you're saying. But the sponsorship strength is, I guess, what are connecting the two is how is it being managed? If it's not you, who are you using to manage it, right? It all plays together.
So Allison, you mentioned Renovo, and I'm wondering, I think of Renovo as private money lending, right? Hard money lending. And when is the right time to go with that type of loan? And why did you go with them?
I think it depends on your deal size, so I've used them on, I think they've done something up to like 3 million at this point. Me personally, I did a 4 flat with them, and then another deal that was 50 units, but price per door, value per door was much less than probably what you guys are working on. So it was like $1.5 million loan. But regardless of size, in addition to size, I think where it makes sense to work with them is when your delta between loan to cost and loan to value is significant enough to make up that spread. And then you have, the first deal that we did with them was all the banks were 70% loan to cost and 75% loan to value. They were 75% loan to value, but 90% loan to cost. So, I own, with my business partner, we own everything 100%. So we could do 3 deals with the capital we had if we use Renovo versus bringing in investors to do those deals. Okay. So we were able to scale a little bit faster using Renovo upfront. Obviously, there's a little more fee and rate, but for us at that time, it was definitely worth it.
Makes sense from a business standpoint. All right, so there was one comment on the chat that I actually would like to hear from, and that is Dean responding to client favoritism. What do you feel like you're favoring certain clients, Dean?
No, if you want to talk agency, I'd say that generally speaking, once you get a first deal in the door, once you're an agency borrower, things get a little easier for you. So perhaps pushing IO, perhaps pushing leverage. I just did a first deal, 20 million or so, 3 properties, central Wisconsin for $125, $150 million guy. He owns everything, maybe 2,000 units, and had done bank up until this point. And our first deal there, given sort of the demographics in north central Wisconsin, we were kind of capped out at 65% LTV, but next deal will be 70 or 75. So, once you're in the door, then the favoritism comes. I guess I don't know specifically what you mean by client favoritism, but sometimes you get a bid where otherwise you might not. Graceway is an example.
Okay. So before we're getting towards the end of the hour, and I want to make sure that you guys do get to share some war stories on the lending side. And more so because I think it's important for everyone watching to try to learn from some of the mistakes that were made, or just from these stories. I'm hopeful that there are some lessons learned. Matt, do you want to start us off?
On the war stories, I had a loan that was supposed to close last year on March 16th as a substantial loan. And the lender called us after business hours on that Monday and said, we're not funding. So it was a shock to the system. I didn't have the nickels in my bank account to go ahead and close anyways. And they basically said, we'll take another look at it later this week. And the deal did end up going away because the seller was kind of done. But and that was just at the height of, and we bought rate protection. We've done all kinds of different things the lender had insisted we do ahead of time. And it was a horrendous experience. So
I don't think there's anything we can learn from that. Just
no.
Sucks.
Well, no, I mean, the thing that you learn from that is even people that, manage 1,500 units, however many buildings that is, their deals fall apart too.
Yeah.
They've paid for these appraisals and this environmental and rate protection, and nothing is guaranteed even to the big guys. And that's a huge lesson.
I stand corrected.
Yeah, no, that's a great
Much
lesson.
wiser
Thank
than
you,
I am.
Michelle. I'll take that one to heart. It's been a year and I still feel the pain, but yeah, I've had a recourse change, to Allison's point earlier, where she had the lenders change terms on her, and that reminded me about 5 years ago I had that happen, and we quickly sort of rerouted it and had to sort of buy our way out of it with the seller to get some extra time to get another loan in place, but. We went from non-recourse loan to recourse loan with a week to go, and that wasn't going to work. So, but yeah, the lenders, again, sort of back to the whole relationship thing. How do you find that lender and sort of talk to the benefit of Kiser and other brokers like yourself? If you're out looking at 6 units, the broker who's showing you a 6-unit property should know the lenders that are going to lend on that type of property. They should have some sort of a relationship. And if they're if they're a savvy broker and they know how to underwrite things and they can help you through that process, because I think there's probably a lot of people on the call that aren't syndicators that are buying 6-unit, 10-unit, 12-unit properties. The brokers are just a fantastic resource because they've seen it all, done it all. They've talked to guys like Sal, and they've talked to people that are buying the first 6-unit property. I think that's and they can hopefully steer you away from some of the lenders that I might have had a bad experience with, because they know that I've had a bad experience with that lender, or that Allison has had a bad experience with. So
I'd like to say that we try to put people together with lenders that we know we've done deals with that have closed and have helped out certain clients in certain ways, for sure. And
Rick,
guys like Dean as well.
And
Rick, okay, I got my
story. Go ahead.
Okay, sorry. I just wanted Rick to have a board up. You have a board in behind you, right? And we're going to start listing the banks that we're not going to work with.
Virtual
right?
background.
Right now.
I wish.
Start listing them one by one. We're going to start putting them up. What was that bank? No, you don't have to put that.
Can't do it.
My war story, quickly, was a deal where it was a development deal, and we had a lawsuit. The lawsuit on paper, it was a $7 million lawsuit for the foreclosure. They said I bought the deal on a foreclosure, and I didn't pay $10,000 per person, and then all of a sudden he tried to sue me for $50,000 per person. $7 million lawsuit on a $5 million property that was going to be a $7 million construction loan, and it was about to be $13 million, so it's very substantial. And the lawsuit was just a shit. It was a nuisance lawsuit, but it was the kind of lawsuit that at the end of the day we ended up paying out $260,000. But anyways, it ended up one bank freaked out, the other bank freaked out. Finally, the bank I'm working with that I've about to do I've had a lot more business since, small bank, $4 billion bank.
You feel like sharing the name of this small bank?
I'll say Great Southern Bank. I'll be happy to share. The great bank, Missouri Bank. They came in, and those kind of situations that take place, Matt, deals that blow up, Michelle, Allison, it forces you to get out of your comfort zone. That's bringing me back to what I said in the beginning. We take the financing as something that we need to just do. It's like a necessary evil just to acquire the property, control the property. But the fact is, us being more sophisticated and getting to know more banks and talk to more different lenders and more sources is something that, for me, this experience, the blow up, though it was a big pain in the ass, it really made me a lot more sophisticated. It made me seek these different relationships. And at the end of the day,
a good lesson learned is talk to these talk to these different lenders, find out, what they can do, because a lot of these different banks can be creative and can help you.
Matt, is it Wintrust? I swear to God, Wintrust is. I'm going to put Wintrust on my list. That's all.
Put Wintrust on your list. I know.
I'd say Wintrust.
Michelle, you wanted to share a war story?
Yeah, I would say just to the audience that just because a bank says no, it doesn't mean that it's a bad deal. It's not personal to you. It is just a property that doesn't fit whatever square peg and round hole they have. So you do have to talk to different lenders for different deals. We were rejected by 2 banks, PNC and somebody else, for this amazing piece of property that we have in Washington Park. And I'm actually happy now that we're with the bank that we're with. And who are we with now? I forgot who it's with now, but it was a new relationship for us. And so it, like you were saying, it forces you out of your comfort zone. If you, as the sponsor of this deal, really believe that this is a good deal, you can find the bank. There's money out there, so just because you get a rejection, don't stop. It's not a bad deal. You're not missing anything. It's just, it doesn't fit that specific bank at this specific time.
Yeah, and I would, I would add on to that in terms of the relationships. Your relationships are all with individual people, with the lenders. And so in the couple of times where I got the retrade, I would call a different lender and say, hey, this just happened to me. I know it doesn't fit for your bank, but do you know anyone? And then getting a relationship from a lender to a different lender, it like moves you up a few notches versus if I just cold called that same bank.
Don't send me nobody sent.
Helps there too.
Right.
Comes back to that. Yeah, that's that works. And Allison, you get to avoid telling any war stories then, because you provided a lesson.
Well, I already provided my war story of retrades earlier in the.
That's true.
Earlier.
Experienced those. So, Dean, I guess before we finish up on the hour here, there's something that we talked about. Well, we've been giving advice, and a lot of the panelists have given good advice for people that are just getting started. A lot of people that are maybe have 2, 3, 4 buildings or looking for their first. But what would you say to the savvy investor who's got a portfolio of 40 buildings and 500 units? What advice would you give that person from a financial standpoint?
Well, just to touch on the smaller folks, perhaps, I would recommend that everyone utilize technology as best you can, get some AppFolio going or do a similar management tool because it looks great to the lenders. We talked about the variety with various lenders. I guess this applies to both small as well as large owners. Stay in the know economically speaking. I follow the Wall Street Journal and others, but Pensford, which is a interest rate advisory firm that's kind of focused on real estate, does a weekly emailing, and they talk about what the Fed's doing, et cetera. And it's quick, it's efficient, and most importantly, it's free. Blackstone has kind of a quarterly as well as an annual mailer in their insights division. So all good things to follow up on. We talked about for large owners, I'd say, manage your recourse as best you can. Use it sparingly. If you need guarantees, try to get them several. Structure burn downs. Banks will do this and say, I'll give you a 75% leverage loan, but maybe 2-3 years after you've executed on your business plan, then let's burn that down. Perhaps a big lesson for folks with a big REO is have your REO in electronic form and kind of update it every 6 months. And, evaluate your sub-performers and defend your action plan to yourself, as well as look forward in terms of rates relative to your prognostication, whether you're following Pensford or Wall Street Journal or Blackstone or whoever. Like evaluate, how your deals are doing and where your rates are at. And, this bodes well for you and company, folks at Kiser. If you have an active communication with your sales broker about deals in your portfolio, things that are coming off prepayment penalty, assets that you're just ready to trade up or trade down or what have you, if you've got a good solid REO, that'll facilitate some good planning.
I'll just add one last thing that you had told me maybe a few weeks ago was stagger maturity. That was one thing that stuck with me for the portfolio owners as an important thing to do. Yeah, absolutely. Stagger maturity. You don't want to refinance or take advantage of a seller's market, when you don't want to refinance a bunch of assets all at once. Minimizes your risk there. Also, perhaps prepayment penalties, right? So if you can get them and get open prepays or structured step downs with little to no cost, you can do a lot of this in the life company world. Those deals are non-recourse and can offer some prepayment flexibility. So somebody offers you a great rate. What's that? We have I was hoping to get into life companies. There was so many topics that we didn't have a chance to discuss. I see my cue of Lee popping up on the screen means it sounds like our hour is over. But I had a great time. I learned a lot. I'm hoping that everybody who tuned in also was able to pick up.
Everybody, let's throw a spitball. Virtual spitball at the professor.
Yeah, thanks, Sal.
Back to high school.
Just remember the B's and H's from Sal, and you'll be fine.
Well, thank you, everyone, for attending. Thank you to all of our panelists, Allison, Michele, Matt, Sal. Thank you, Rick, for moderating. Very special thanks to Dean Huber. He and Walker Dunlop both are sponsors of the Mid-Market Summit, and they sponsored us for the 2020 Summit, which never happened, of course, but have hung in there with us the whole way. So really appreciate your support of this series, Dean, and thanks for participating today. Also, you can tell I'm not in the Kiser Group's conference room anymore. Of course, that was a green screen virtual background, and my internet went down midstream on this. So I'm now doing this via cellular on my iPad. So wishing everybody a wonderful week. To close this out, thank you again to all of our panelists. A reminder, next week, we will have a technology discussion, and we'll have WPD management, CAS management, and Xfinities on Xfinity Communities on that panel, hosted by Kiser Group's own Aaron Sklar. Final thank you to Sabrina Wetrig, and all of you on this panel have interacted with Sabrina. Thank you for all your efforts, our fabulous publicists, for pulling all this together for us. Thank you all who attended. Hope you got a few good takeaways from this, and hope to see you next week. Thank you.
Thanks, guys. Thank you. Take care.